Welcome to Module D, Balance Sheet Management. In this module, we will understand how banks manage their assets and liabilities to maintain the profitability, liquidity and solvency. We will study asset liability management, interest rate risk, liquidity risk, capital adequacy and regulatory requirements under the Basel norms. Effective balance sheet management helps the banks control the risk while ensuring stable. And by the end of this module, you will clearly understand how strategic financial decisions impact a bank overall financial health. So let's start with module D.
Components of assets and liabilities in bank balance sheet and their management. So today we are going to start our module D, and this chapter is important where we will learn that all the concepts related to the components of assets and liabilities. Right? So I am hoping that you all are fine and doing well. And also I am audible, my screen is visible. So let's start with the class where we will learn concepts through questions that will help us to understand the concepts related to this chapter. So here is the first question, which is saying that if a bank shows an increase in the deposits and simultaneously increase in advances of the same amount, what is the most appropriate interpretation here? So before solving this question, here understand one concept. We know that suppose bank is a large water tank. Sources of funds are where from the water comes, and application of funds are where the water is used. So in the bank balance sheet, the left side shows liabilities and the right side shows assets. Right? Right side is liabilities, left side is assets. Now, in the bank balance sheet, we know that this is left side, this is right side. So, no matter what, the rule is strict that total sources of funds is equals to total application of funds. Right? This equality ensures financial discipline and transparency, which is critical from a regulatory and risk management perspective under the things. Right? So, what is the answer of this question? That if a bank shows an increase in deposit and simultaneously increase in advances of the same amount, what is the most appropriate interpretation here? So the answer is option B, because here we can say deposit and advances increase equally, which expands the balance sheet but not impacting capital or the net worth. So the correct option is option B here. In the next question, why is bank capital, treated as long-term source of funds? Why is this bank capital treated as long-term source of funds? What is the answer according to you? Simple. The correct answer is here. Say, think of the capital as the shock absorber of the banker. Capital is the shock absorber of the banker. When the road is smooth, that means profit. No one notices it. When the road is rough, losses are there. capital protect the depositors and as well as creditors, right? So capital represents the owner's stake and long-term source of funds. It is not repayable like deposits and it absorbs the losses at first. So we can say that capital ensures financial stability, protects the public confidence, and also supports risk-taking capacity. So why is bank capital treated as a long-term source of funds? Because it is repayable only after all the liabilities are settled. It ranks last in repayment and absorbs the losses, which make it permanent in nature. So, which of the answer is correct? Here, option B is definitely correct here. Now, which of the following best distinguishes reserves from capital? Which of the following best distinguishes reserve from capital? So, which answer is correct according to you? Very simple. Let's understand the concept. If capital is the foundation, reserves are the saving bank of the bank itself. Over the time, profits are not fully distributed. Some of them are retained as reserves, like statutory reserves, capital reserves, revenue reserves, share premium, balance in profit and loss account. These reserves strengthen the bank internal financial resilience and support the growth. So that's why reserves are the accumulated profit which are retained in the business. So the correct answer is option B. Reserves arise mainly from the retained earnings. So that's why option B is correct here. Right? Now, which deposit category poses the highest liquidity of the risk of the bank? Which deposit category is the highest liquidity risk to the bank? So, which answer is correct according to you? C. Very simple answer. We know that deposits are the fuel. Deposits are the fuel that keep the bank engine running. That keep the bank engine running. They are the primary and cheapest source of funds. Primary and cheapest source of funds. What? Demand deposits, right? Demand deposits, saving bank deposits, as well as term deposits. Now, the thing is that what is the meaning of these demand deposits? They are always payable on demand, like current deposits and overdue deposits. Then we have saving bank deposits, which are semi-liquid, which are interest bearing. And term deposits, they are repayable, but after a fixed period. The bank have to manage deposits carefully. Why? Just to balance liquidity, cost, and maturity risk. So, which answer is correct here? The answer that which of the deposit category having the highest liquidity risk? That is current deposit, which are payable on demand, which can be withdrawn anytime. So the correct answer is current deposits. Now, borrowings are generally considered inferior to deposits because borrowings are generally considered inferior. But why? If we relate to the deposits, which answer is correct? See, when the deposits when the deposits are not enough. So in that case, banks borrow like a household, taking a temporary loan, right? Bank takes a temporary loan. And from where these borrowings come? These borrowings come from the RBI, other banks, institutions like NABARD, Exim Bank, and IDBI. And these funds are very costly, and these funds are for only short term and for medium term. And these are used mainly for the liquidity shortage or liquidity support, right? So, which category? Basically, borrowings are generally considered inferior to deposits because borrowings are always sensitive to the market conditions and they are volatile and costlier also. So option B is correct. Got it? Now, next question is here. Interest occurred but not due is classified as a liability because interest occurred but not due. See, suppose there are the bank's pending obligation, like unpaid bills are the household. Unpaid bills are like the household. They include bills payable, inter-office adjustments, interest occurred but not due, tax provisions, and other statutory liabilities. So they are temporary but unavoidable liabilities. So interest occurred but not due is classified as a liability because it represents an obligation that already incurred. Interest has incurred, but payment date has not arrived. So that's why option C is correct here. It represents as obligation which is already incurred. Option C is correct here. Why do banks maintain balances with the RBI in excess of CRR? Why do banks maintain their balances with the RBI in excess of CRR? Which option is correct according to you? So let me tell you, very simple. See, we know that bank cash and balances with the RBI. This is the bank's emergency wallet. It includes cash in hand, foreign currency cash, CRR balances with RBI, surplus balances with the RBI. So this is the most liquid asset but earns minimal or no return. So it we can say that why do banks maintain this RBI? Just to meet unexpected liquidity needs. So option C is correct here. RBI surpluses the balances and they are not result return oriented. So option C is correct here. Right? Now the next question. Funds transacted under money market, which is differ from call money primarily in terms of funds transacted under the notice money market, which is different from call money primarily in the terms of simple. Think like this that balances with the banks and money at call and short notice is like a bank friendship wallet, right? Which means sometimes bank does not keep money with the RBI, right? But with other banks, just like keeping spare cash with the trusted friends. So this component includes balances in current and term deposit account with other banks, call money, which means funds lent or borrowed for overnight. And in the notice money, it is happen for 2 to 14 days, right? 2 to 14 days. So these instruments helps the banks managing short-term liquidity mismatches efficiently without disturbing long-term assets. So whatever the funds transacted under the notice money market differ from the call money market primarily in the terms of tenure of the transaction because call money is overnight and notice money ranges from 2 to 14 days. So which option is correct? Option C is correct. Tenure of the transaction. Now, which of the following best explains why government securities dominate a bank investment portfolio? Why the government securities dominate a bank investment portfolio? So let's understand the concept. Suppose if cash is the wallet, so investments are the bank's fixed income portfolio. Bank invest in government securities, approved securities, shared debentures, bonds, subsidiaries, and joint ventures. But investments serve only for three critical purposes. For what? Income generation, right? For the income generation, for the liquidity management, and for the statutory compliance, right? So we can say investments are the controlled risk assets. So basically, in the given that explaining that government securities dominate a bank investment portfolio because they have to meet statutory and liquidity requirements. So GSECs satisfy the SLR and they are very highly liquid. That's why option C is correct, that they help in meeting the statutory and the liquidity requirements. Now, why do advances pose in the highest risk return trade-off for the banks? Why do advances pose the highest risk return trade-off for banks? So, which of the question is correct? Like which of the option is correct? See, advances are the earning engine of the bank. All the advances, they are the earning engine of the bank, right? Now, every loan, cash, credit, overdraft, or bill discounting given to the customers comes under the advances. They form the large portion of assets, they generate interest income, they carry the credit risk. Hence, advances decide both profitability as well as survival of the bank as well as survival of the bank. So why do advances pose the highest return risk return trade-off for the banks? Because income generation comes with the default risk. They generate the income but expose the bank to the credit risk. So we can say that the correct answer is here option, that is, they generate income but expose the bank to the credit risk. So which option is correct? C option is correct. Right? Why fixed assets considered as non-earning assets? Why are fixed assets are considered as non-earning assets? Fixed assets are the bank's office infrastructure, right? And basically, they include buildings and premises. They include furnitures and fixtures. They include computer and hardware, vehicles, and these assets do not earn income directly but are necessary for the operations. So they are not generating any interest income. That's why fixed assets considered as non-earning assets. They support the operations but not the interest, right? So the correct answer is here option B. Now, next question we have. Now, which best captures the ultimate objective of the AI? Which best captures the ultimate objectives of the AI? You can think like alien is a driving a car, driving a car while balancing the um, like speed, fuel, and safety, right? While balancing the speed, fuel, and safety means bank borrow the funds and lend the assets. If timing, rates, volumes, mismatch, risk arises, right? If these things are mismatched, in that case, the risk arises. So asset liability management is the process of planning, acquiring, and directing the flow of funds. Right? Planning, acquiring, directing the flow of funds. And the ultimate objective is stable earning, growth in equity, controlled risk taking. So, which best captures the ultimate objective of ALM? ALM balances profitability as well as risk. So, the correct answer is option C, that stable earning with measured risk taking. So, option C is correct here. Asset liability matching primarily helps in reducing what? Which risk is reduced in this? So you can say uh, without ALM, a bank is like a bucket with holes. A bank is like a bucket with the holes. ALM helps in matching the assets and liabilities, right? Also minimizing the liquidity risk and minimizing the market risk, right? So bank may even match specific assets with the specific liabilities, which ensures certainty in the cash flows. So asset liability matching primarily helps in reducing matching times, and rate reduces the mismatch risks, that means liquidity and market risk. So option C is correct here. Now, embedded options in bank products increase ALM complexity because embedded options in banking products increase ALM complexity because which of the option is correct? See, you can think ALM is critical because banking is not now simple or predictable, right? So that's why ALM is very important. Why? Because there is volatility in the interest rate. There is the product innovation. There is regulatory environment. There is prepayment, withdrawal, and also management recognition of risk return trade-off. So, embedded options means customers may prepay or withdraw early. So, they alters the customer behavior unpredictably. So, option B is correct here. Now, which ALM action directly stabilizes net interest income? Which ALM directly stabilizes this net interest income? So, very simple. You can think like that. NII measure what bank earns today from its core uh, business or core activities, right? So, what is the NII formula? Whatever the interest income subtracted interest earned, right? The difference of this is called net interest income. So if volatility is there in the interest rate, that directly affects the NII. So ALM aims just to stabilizes the NII in the short term. So which ALM action directly stabilizes net interest income? That is, repricing gaps cause the NII volatility. Volatility means ups and down, movement. So matching the repricing period of asset and liabilities, that option is correct here. That is the action that directly stabilizes net interest income. Now, two banks suppose have identical NII. Which bank will have a higher NIM? If two banks have identical NII, which bank will have higher NII? NII is NIM is net interest margin. NIM is net interest margin. And basically, this is calculated NII divided by average total assets. That is NIM. Average total assets are divided, NII divided by average total assets. So NII shows that how efficiently assets are earning the interest. So two banks if have identical NII, we can say if smaller denominator is there, it increases the NII. So that means those bank which has having low average total assets, that will have higher NII. So option C is correct here. Right? Now, a decline in economic equity ratio indicates, if there is a decline in the economic equity ratio, that indicates see, very simple, that economic equity ratio, that tells what? That answers a survival question. Which survival question? That how much of the bank is owned versus borrowed. So it will be shareholder funds divided by total assets. That is the economic equity ratio. Higher ratio means greater shock absorbing capacity. This is a company's basically financial metric that compares the total share equity with the total assets. So if there is a decline in the economic equity ratio, means it increased the leverage and vulnerability. Lower owned funds increases the risk. That's why option B is correct here. Now, pricing matching in ALM primarily aims to protect what? Pricing matching. See, ALM have two objectives. First one is pricing matching and second one is liquidity management. Right. In the price matching, lending rates have to exceed cost of funds. And in liquidity management, asset and liabilities are grouped by the maturity and gaps are analyzed to plan the funding needs. So spread ensures the profitability. So we can say the correct answer is here, just to protect the interest spread. So option B is correct here. Got it? Now the next question is, which stage of ALM directly impacts the profitability calculation? Which stage of ALM directly impact to the profitability calculation? So, very simple answer is there. We know that ALM is not isolated. It coordinates every balance sheet function. Balance sheet function or balance sheet management we can include in this. In the asset side, liquidity, investment, loans, fixed assets, and in the liability side, deposits, borrowings, capital. Apart from this, it will do income expense management, right? And profit depends on interest income, interest expense, provisions, not interest income, and expenses and taxes. So balance sheet structure affects the income and expenses. So we can say both stage 1 and stage 2. Option C is correct, right? So in today's class, we are going to start one of the most important topic, that is the Basel Capital Adequacy Framework. So many of the candidates are confused with these norms. So today we will learn this topic through real Indian banking scenarios. So let's start with the class. So for the first question, if I ask you that under Basel II minimum capital requirements under Pillar 1 covers what? Under Basel II. See, currently we are with Basel III. And suppose imagine you are a branch manager of a large commercial bank in the Mumbai, right? Now that thing, one day a large corporate borrower applies for 500 crore loan, right? 500 crore loan. Okay. Now you also have housing loans. You also trade in government securities. Your branch also handles thousands of digital transactions. Now think carefully. What if borrower does not pay on time or not repay? That means credit risk is there. What if interest rates suddenly increase? Market risk is there. What if some staff commits fraud or system crashes? That means operational risk is there, right? If the bank collapses, depositor money is at the risk. So RBI says, dear bank, before you take risk, you have to keep capital in a as a safety cushion. That is pillar one. So pillar one require banks to maintain minimum capital against credit risk, market risk, as well as operational risk. Capital credit risk, market risk, operational risk. Earlier, Basel 1 only credit risk was covered. Under Basel 2, operational risk was included for the first time and capital is calculated in a very risk sensitive manner. So, more risk means more capital and less risk means less capital, right? So the correct answer is simple, that under Basel II, minimum capital requirements under Pillar 1 covers what? Credit risk, market risk, and operational risk. So Basel II Pillar 1 explicitly includes credit risk, market risk, operational risk. Operational risk was introduced for the very first time under the Basel II. So the option C is correct here. Now, the revised adequacy norms for the capital are applicable to that revised capital adequacy capital requirement. See, suppose RBI issues a circular, right? Now, revised capital adequacy norms are applicable to all the commercial banks. But one branch manager asked, what about cooperative banks? Answer, not applicable. The framework applies to all commercial banks except cooperative bank, local area bank, regional rural banks, and capital must be maintained at the solo level and at the consolidated level. So, revised Basel norms apply to all the commercial banks, not to the cooperative banks, not to the local area banks, not to the regional rural banks. It is applied at solo level and as well as consolidated level. So, what is the correct answer of this? The revised capital adequacy norms, they are applicable to these are applicable to all the commercial bank except cooperative bank. So option B is definitely correct here. Now, under the pillar 2, supervisors are expected to, under the pillar 2, supervisors are expected to, see, suppose RBI inspection team visited your bank, right? Now, we know you maintain minimum capital. They say that we know you maintain minimum capital. But how do we know you understand your risk properly? They ask, do you assess your overall capital adequacy? Do you have a strategy to maintain the capital? Do you review your risk profile? Do you intervene early if capital fails? That is pillar 2 supervisory review process. Pillar 2 ensures bank develop proper risk management system. Supervisors review bank internal process. Bank hold capital above the minimum if required. So four principles are there. First is saying that bank have to process to assess overall capital adequacy. Principle 2 is saying that supervisors must review and evaluate bank internal assessment. Principle 3 is saying bank should operate above minimum capital ratios. Principle 4 is saying supervisors have to intervene early if capital falls. Right? So, under pillar 2, supervisors are expected to require banks to hold capital above minimum if needed. That is the option C saying. Require banks to hold capital above minimum if needed. Now, ICAP. ICAP should be reviewed by the board. What is that ICAP? ICAP is Internal Capital Adequacy Assessment Process. Internal Capital Adequacy Assessment Process. Imagine the board of directors are sitting in a meeting. Chairman asks, do we know how much capital we truly need considering all our risk? The risk officer says, yes, sir, we have ICAP. ICAP means Internal Capital Adequacy Assessment Process. Every bank have to maintain that ICAP that covers entire firm-wide risk profile. It should be reviewed at least once in a year and it should be integrated into business decisions. It is not just a document, it must be a part of decision-making culture, right? So, ICAP helps in internal capital allocation, pricing of loans, credit decisions, as well as expansion planning and budgeting. So we can say which answer is correct? Our answer is correct. ICAP should be reviewed by the board. Board have to assess and document the ICAP at least once annually. So at least once a year. Option C is correct here. Got it? Now, next question. Which pillar focuses on transparency and disclosure? Which pillar focuses on transparency and disclosure? Suppose a depositor wants to open fixed deposit in your bank. He check capital ratio, NPA levels, risk exposures, financial disclosures. If bank hides information, confidence falls. So Basel introduced pillar 3 that is called market discipline. Pillar 3 promises what? Transparency, disclosure, market confidence. So bank must disclose sufficient information so investors can evaluate the risk, depositors can assess the stability, market can discipline the risky banks. Disclosures should be clear. Disclosures should be comprehensive. Disclosures should be meaningful. Disclosures should be consistent over the time. And yes, disclosures should be comparable across the banks. So, which pillar focuses on transparency and disclosure? Simple answer is pillar 3. Pillar 1 is dedicating to minimum capital requirements. Pillar 2 is saying supervisory review process. And pillar 3 is market discipline. Right? So, three pillars which we have to take the importance of these three pillars in Basel third also. Right? So, today we know that how the RBI supervises the bank, why disclosures build confidence, how ICAP connect the strategy with the capital. All these things are just because of these pillars. Got it? Now, the next question. The principle of proportionality in ICAP means important one. The principle of proportionality. So let's learn this concept, principle of proportionality, where we will learn this with this concept, small bank versus big bank or large bank. So let me tell you one story. Imagine two banks are there, Bank A, Bank B. Bank A is small regional bank, limited branches, only retail loans. Bank B is very large multinational bank used for forex trading. Derivative exposures are there. Corporate lending is there. Overseas subsidiaries is there. So now tell me, should both banks have the same complex ICAP? No. This is where the principle of proportionality comes in. The implementation of ICAP should depend on the size of the bank, the complexity of the operations, the risk profile, the nature of the activities. Small bank, simple ICAP. Large complex bank, detailed ICAP. So ICAP should be proportionate to the business model, risk exposure, and the operating environment. Right? ICAP should be that proportionality should be like that. So we can say ICAP implementation should be proportionate to the bank size, complexity, and the risk profile. So which option is correct? Option C is correct. ICAP should reflect size and complexity of the bank. Option C is correct here. Now, ICAP being forward looking means it should ICAP being forward looking means it should. So let me tell you one thing. Suppose your bank plans open 200 new branches, increasing the corporate lending and expanding into the foreign exchange trading. So should ICAP look only at the current capital? No, it must look at the future risk. Right. So ICAP is also the forward looking. ICAP have to consider future strategic plans. ICAP have to consider macroeconomic conditions. ICAP have to consider expected capital constraints, and ICAP have to estimate future capital needs. Right. So we can say it is not backward looking, it is forward looking. So bank capital needs what? Like plan for the emergencies like sudden losses, economic crisis, and for liquidity shortage. So forward looking ICAP considers future plans, economic factors, and potential capital constraints. So which option is correct here? Simple. We have the correct option that it considers future strategic and macroeconomic developments. Option C is correct here. Now, under the ICAP, capital target should be under the ICAP, capital targets should be. Suppose a bank gives high risk unsecured loans and has large exposures to the volatile sectors, right? Now, trades are there in the derivatives. Another bank also only give government backed loans. Should both have same capital target? Obviously, capital adequacy depends on the risk profile. Capital adequacy is a function of risk profile, operating environment. Bank have to set the capital targets consistently with the level of risk, business exposure, economic environment. If the higher risk is there, higher capital target is there. If the lower risk is there, lower capital requirement is there. So under the ICAP, capital target should be depends on the risk profile. Capital target must align with the risk exposure. So which answer is correct? Option obviously C is correct. Consistent with the bank risk profile. Option C is correct here. Now, stress testing under the ICAP is conducted to stress testing under the ICAP. Suppose RBI says and ask your bank, what if GDP falls by 5%? What if GDP falls by 5%? What if interest rate rise sharply? What if major borrower default? Your bank runs simulation models. That is called stress testing. As a part of ICAP, banks have to conduct periodic stress test. It covers all the material risk exposures. It tests unlikely the events. Example, global financial crisis, pandemic, sharp currency depreciation, and the purpose of it to evaluate the impact on capital, profitability, and liquidity. So stress testing under ICAP is conducted to evaluate the impact of adverse but plausible events. Stress testing evaluates the impact of unlikely but plausible adverse events on the bank capital and risk exposure. So the correct answer is there. Stress testing is always evaluate the impact of adverse situation, means where the banks are put into the adverse situations. Now they check the condition of the banks, how banks will deal in the stressful situation. That is called stress testing. It means evaluating the impact of adverse but plausible events. So option C is correct here. Now, what is the primary purpose of ICAP document? The primary purpose of ICAP document is to what? So very simple. Imagine yourself, you are a chief risk officer. You present ICAP to whom? Board of directors, RBI supervisors, and you submit a detailed document. That is the ICAP document. ICAP document is a comprehensive document which explains entire risk spectrum, which explains the risk mitigation strategy, which explains the current capital and future capital requirement. And the purpose of this ICAP is just to inform board, explain to the RBI, and it shows the internal capital management approach. So what is the content of the ICAP document? Simple, we can say that the content of this ICAP, just a second. So here we can say that in the ICAP document, we can include executive summary, background, current and projected financial position, capital adequacy, what is the use of ICAP within the bank, what is the aggregation and diversification, how to do the testing, how to do the adoption, everything. And the purpose of this ICAP is just to summary of the to see the overview, the ICAP methodology. Right? So we can say the only primary purpose of that ICAP document is just to inform the board and explains them about the internal capital adequacy assessment process to the RBI. So which answer is correct here? Simple here, the answer which is correct, that is option B. Option B is correct. Apprise the board and explain the capital assessment to the RBI. Option B is correct. Now, ICAP document must clearly specify. ICAP document must clearly specify what? Suppose, imagine RBI is reviewing your ICAP. RBI is reviewing your ICAP. He asks, when did you assess your capital? What risk did you consider? What assumptions did you make? Your ICAP have to clearly mention three things. First, the timings, right? Timings means when ICAP document must specify when the assessment was done, what is the period covered, then what are the risk analyzed. Means that credit risk, market risk, operational risk, liquidity risk, reputational risk, off balance sheet risk, and that methodology and assumptions. Means what are the methods used, models used, stress assumptions, economic scenarios, all these things. So ICAP document have to clearly specify what is the time of assessment, what is the risk analyzed, and what is the methodology assumption used. So that's why option B is correct here. Timing, risk analyzed, and as well as methodology. Got it? Which of the following must be considered under firm-wide risk oversight in the ICAP? Which of the following must be considered under firm-wide risk oversight in the ICAP? C. A bank give guarantees and letter of credit, and these do not appear as loans in the balance sheet, but still risk exists. That is called off-balance sheet exposure. ICAP to have to consider entire firm-wide risk. ICAP have to cover risk management, off-balance sheet exposure, reputational risk and support, stress testing practices, and also some type of compensation practices. So ICAP have to consider off-balance sheet exposures, including that securitization. So option C is correct there. So under the ICAP, analysis of economic recession primarily evaluate impact on. So try to give the answer, then I will explain you the answer. That what is the answer of this under the ICAP, analysis of economic recession primarily evaluates the impact on. Very simple. Suppose GDP declines, corporate defaults starts increasing, market falls. What happens? Capital funds reduce, earnings decline, CRAR falls. So ICAP have to analyze this. This section explains the impact of economic recession, business cycle downturn, and market decline. We know that what is the formula of CRAR? CRAR is capital divided by risk weight assets. Right? This is the formula of capital adequacy ratio. Right? So, under the ICAP analysis of economic recession, that impacts on the CRAR because it analyzes the study of downturn on capital funds and CRAR. So simple, if economic recession analysis happens, that will definitely give impact on the capital funds and the CRAR. So option B is correct here. Now, management action section in ICAP should include management section actions, action section in ICAP included what? See, during the crisis situation, management may raise fresh capital, maybe reduce the lending, and it cut the dividend and sell the risky assets. ICAP must explain these actions. These sections must include quantitative impact of the management actions, sensitivity testing, and past evidence. So if management does nothing, what happens? And if management act on time, then what improves? So that is the thing. That's why the management sections are there in the ICAP, because ICAP show evidence of management actions which are taken during the similar economic stress periods. So the answer is evidence of past actions during the stress. Right? Now, aggregation in ICAP refers to aggregation in ICAP. Everything about the ICAP will be clear to you. What, see, first of the thing that credit risk is there from the loans, right? Market risk comes from the treasury. Operational risk comes from the branches. All must be combined. That is called aggregation. Combining of the all risk assessment and diversification means reduction of the overall risk due to spread across activities. So ICAP combine all risk, take overall capital view. So we can say that aggregation of that ICAP refers to combining the separate risk assessments, means bringing together all risk assessment to determine the overall capital adequacy. So which answer is correct here? Here our option B is correct, that is combining the separate risk assessment. Now, testing and adoption of ICAP ensures testing and ICAP, adoption of ICAP ensures very simple. See, we know that before presenting ICAP to the RBI, internal audit test models, calculations, and assumptions. That thing will ensure reliability, right? Because it includes what is the validation of the model, control processes, and internal challenge process. So, testing and adoption of ICAP means there should be the calculation of the models must be accurate, must be correct. So, accuracy and robustness of the models. So, option B is definitely correct. Now, use of ICAP within the bank means. Bank, how can we use this ICAP in the banks? How can we use? Mm, Suppose credit department checks, does the loan affect our capital planning? That means ICAP is embedded in management. ICAP must be integrated into capital modeling, into scenario analysis, into business decisions, and also risk appetite framework. So, capital management should be the part of daily operations. ICAP must be embedded in capital management and decision making culture. So, ICAP influences the business decisions. That's why option B is correct. ICAP influences that business decisions. Now, disclosure of interest rate risk in banking book is referred to as Basel disclosure requirements. That is according to the RBI Master Circular. Under Basel III regulations, RBI requires bank have to disclose detailed risk information. And these type of disclosures always ensures transparency, right? That means in which we can include scope, capital adequacy, and about the credit risk approach, how to mitigate the credit risk, operational risk, interest rate risk in banking book, counterparty credit risk. These types of enclosures must be there. So disclosure of interest rate risk in the banking book is referred to as IRRBB. IRRBB means interest rate risk in the banking book. So the correct answer is option A, IRRBB. Now, which approach is commonly opted by Indian banks for computing market risk capital? Which approach is commonly opted by Indian banks by computing market risk capital? Simple. Imagine you are working in Treasury Department at large Indian bank. RBI says you have to calculate the capital for market risk. Treasury team asks, should we use complex internal value at risk model or standardized approach? Most of the Indian banks prefer a simple regulatory method that is called standardized duration approach. Under the Basel framework, banks can compute market risk capital using the standardized duration approach, which is opted by Indian banks, standardized maturity approach, internal models approach, and advanced measurement approach, which needs RBI approval. And Indian banks commonly use standardized duration approach because it is regulator prescribed, it is very simple, it requires less model validation. So Indian banks commonly opt for the standardized duration approach for computing market risk capital. So which answer is correct here? Simple. Which option is correct here? We have the correct option A, that is standardized duration approach for the market risk capital. Option A is correct here. Now, what are the two options available for computing market risk capital? As I told you, apart from the standardized duration approach, other options include standardized maturity approach, advanced measurement approach. In advanced measurement approach, RBI approval is needed. So, option B is correct here. Now, which approach is used by the Indian banks for computing operational risk? That is BIA, Basic Indicator Approach. Basic Indicator Approach, which means capital is calculated with the percentage of gross income. Right? It is very simple and less model based method. So, simple BIA is the correct answer here. Now, the revised capital adequacy norms uniformly applies to revised capital adequacy norm. Suppose there is a cooperative bank manager. Ask, do Basel revised norm applies to us? No. The norms apply uniformly to the commercial banks. Revised capital adequacy norms applies to the commercial bank, not to the cooperative bank, not to the local area bank, not to the region rural banks. It applicable to commercial bank. Uniform application is there. It excludes any cooperative bank. It excludes any RRB and it excludes local area banks. So the norms applied, but only on all the commercial banks. Option D is definitely correct here. Now, consolidated bank is defined as, what is the meaning of that consolidated bank? So, very simple. If we talk about that consolidated bank, you can think that suppose there are three companies, ABC, Bank Limited, ABC, securities, and as well as ABC housing finance. Now, all these controlled by the ABC Bank Limited. So, when RBI calculates the capital at group level, that is called consolidated level. Consolidated, consolidated bank means a group of entities where a licensed bank is the controlling entity. Control means majority ownership, decision making authority, and capital must be maintained at solo level or consolidated level. So, a consolidated bank is defined as group of entities where a licensed bank is the controlling entity. So, option B is correct. Group where a licensed bank is the controlling entity. Option B is correct here. Now, what entities can be excluded by the consolidated bank for maintaining minimum CRAR? For maintaining that CRAR. See, here we can say if a bank owns a manufacturing company or a hotel business, should these be included in the CRAR calculation? No. For capital adequacy purpose, these type of entities can be excluded. For maintaining minimum CRAR, a consolidated bank can exclude those entities which are not related to the financial services. If entity is non-financial, it may be excluded. But financial service entities are included always. So what is the correct answer here? Entities not pertaining to the financial services can be excluded for the CRAR consolidation purpose. So option B is correct. Entities not pertaining to the financial services. Now, what approach for operational risk is recommended by adoption of commercial banks in India as per the RBI decision? RBI say recommend simple DIA for the operational risk, right? Which approach? This is repeated. Okay. Okay. Which banks are excluded for adopting the standardized approach for credit risk? I told you that thing that we excluded all the commercial banks, right? Commercial banks are excluded. Sorry, commercial banks are covered apart from this. Cooperative banks, all of the above is the answer. Local area banks and regional rural banks are excluded. Now, why was the decision made to adopt international standards for risk measurement in Indian commercial banks? Why was the decision made to adopt international standards for risk measurement in Indian commercial banks? The answer, the purpose, just to achieve the consistency, just to achieve the harmony with the international banking standards. That's why this is adopted. Which pillar focuses on minimum capital requirement? Pillar 1. And what does Pillar 2 of Basel 3 primarily involve? Supervisory review. So in today's class, we are going to start a very important topic, that is asset classification and provisioning norms. A very good chapter and very important chapter for our examination. So let's start with the class where we will discuss some MCQs. First, we will discuss concepts and the related MCQs. So let's start with the class. So here, first question is, what is the primary purpose of asset classification in the banks? What is the primary purpose of asset classification in the banks? So here, if I tell you, imagine that you are a branch manager in a small town branch of a public sector bank in India. You have variety of loans in your portfolio. Some are home loans, some are business loans, some are gold loans. One day, your regional manager asks you to categorize all your loans based on how safe or risky they are. You realize that some loans are paying regularly, some have delayed payments, and some borrowers are not paying at all. So, you need a systemic way to organize all these assets so that you can manage the risk, report to the RBI, and take the corrective action. This is exactly why asset classification exists. Asset classification is a systematic approach to categorize and manage the bank assets based on their types, their functions, their performance. It helps the bank in identifying the risky loans in a very early stage, monitor them, and ensures regulatory compliance. So, what is the primary purpose of asset classification in the banks? So very simple answer is there to categorize and manage the bank's assets systematically, right? Means asset classification allows bank to organize their loans and other assets based on risk and performance, which helps in monitoring and reporting. It is not about increasing the income. It is not about like reducing the borrowers. It is about just management, right? So now the next question: when a bank loan classified as NPA, when a bank loan classified as a NPA. So what is NPA? You know that NPA means who are not paying the EMI or principal amount for more than 90 days, so that loan become NPA for the banks. So we can take the example here. Um, Now let's take the example of Mr. Sharma, a business borrower from the Jaipur. He took a loan from your branch to expand his shop. For the first 6 months, he paid regularly. But after that, due to some business losses, he stopped paying interest and principal. You notice that the loan has stopped generating income for the bank. So what should you do? This is this type of condition is the NPA situation, right? NPA is an asset or loan which ceases to generate the income for the bank. Income here means interest or principal payments. If the borrower stops paying, the loan is classified as NPA, right? So, when a bank is loan classified as a NPA, very simple answer is there. When the loan ceases to generate income for the bank, NPA status arises early when the borrower stops paying interest or principal, affecting the bank income from that asset. So when the loan ceases to generate income for the bank, when that loan stops generate income for the bank. So option B is correct here. Now, which of the following is a substandard asset? Which of the following is a substandard asset? Which of the following is a substandard asset? Now, again, we are learning here substandard means we are talking about the categories of the NPA, right? Because we have the categories of the NPA. We can continue with the Mr. Sharma's case. Your branch monitors that his loan is uh, for the 12 months, right? For the 12 months. Now, in the first year, he misses the payment, but occasionally pay small amounts, right? After a year, his loan is still irregular. And after further checks, you find that recovery is doubtful from this loan. Finally, after audit, you realize that the loan may not be recoverable at all. So these stages corresponded to substandard, doubtful, loss assets. So substandard assets are those assets in which NPA for less than or equal to the 12 months. Right? Like loan is not giving payment for 12 months, which is a very early stage of trouble. Recovery is possible. In the doubtful assets, assets which have been substandard for more than 12 months. Right? Recovery is uncertain here. In the loss assets, these assets identified as unrecoverable by the bank or the auditors, but not yet written off. So there is no hope of recovery. So substandard assets are those assets which are having equal to or less than 12 months NPA. Doubtful assets when that loan is unpaid for more than 12 months. Loss asset identified, that means loss assets identified when the assets is there is no chance of recovery. So which of the following is a substandard asset? Asset which has remained NPA for less than or equal to 12 months. So substandard assets are early stage NPAs. NPA period is less than or equal to 12 months, so still have recovery potential. So option B is correct here. Next question. A working capital account with irregular drawings become NPA if such drawing continue for how long? If a working capital account with irregular drawings become NPA, such drawings continue for how long? So now imagine there is another borrower, uh, Mr. Verma, who is running a small textile amount, right? Sorry, textile unit, small textile unit. Sometimes she draws slightly more than her working capital limit because of unexpected demand, or she misses uh, submitting her stock statement. However, her overall business is fine. She pays later. Should that bank classify her account as NPA immediate? Here, the temporary deficiencies are considered. Account with the temporary deficiencies may not be immediately classified as NPA. Drawings should be covered by adequacy of current assets. If irregular drawings continue for 90 days, the account become NPA. Regular and ad hoc credit limits must be reviewed and regularized within 3 months. So, what is the meaning of that ad hoc limits? Ad hoc credit limits? That word, ad hoc credit limits. That means these are the temporary short-term enhancement to a borrower existing working capital facilities, which is typically granted for the banks by the banks for 30 to 90 days. Right? So here, as per the RBI guidelines, temporary deficiencies are tolerated. But if irregular drawings continue for 90 days, the account is classified as NPA. So the correct answer is here option C, 90 days. So asset classification, which categorizes the loans based on the type and performance. Non-performing assets, where loan stops generating the income. Substandard assets, where NPA is equals to or less than 12 months. Recovery is possible. Doubtful assets are those where the loan is more than 12 months, uncertain recovery. Loss asset means asset identified as loss by the bank or the auditors. And what is the meaning of temporary deficiencies? Temporary deficiencies is a 90-day rule where minor irregularities tolerated up to 90 days, right? So the next question, when a loan account become classified as NPA, be upgraded to a standard account? When? When if a account classified as NPA, then account can be upgraded to a standard account. So what is the answer here? Very simple. Imagine again you are a branch manager in Lucknow. One of your borrower, Mr. Ramesh, had taken a loan to his manufacturing unit. Due to some financial stress last year, his account became NPA. Now, after restructuring and some business recovery, Mr. Ramesh start paying interest and principal regularly again. You have to decide now. Should this account still be treated as NPA or can be upgraded to the standard account? So, if the borrower pays all the arrears of interest and principal, the account ceases to be NPA and can be classified as standard. For accounts which are classified as NPA due to restructuring or non-achievement of the operations, special instructions apply here, right? So, when can a loan that NPA can be upgraded only when arrears are cleared and the account shows satisfactory performance, not immediately after restructuring. So after payment of arrears of interest and principal and satisfactory performance, that NPA can be upgraded to the standard account. So option B is correct, right? For an MSME account with exposure less than 25 crore, the NPA account can be upgraded to standard after for an MSME account? See, you can take the example here of Miss Priya, who runs a small garment unit in a Jaipur. Her bank account had become NPA due to missed payments. Her total exposure from all the bank is less than 25 crore. So obviously it is an MSME account. After resuming payment, you need to monitor her account before upgrading it. For MSME account, aggregate exposure must be less than or equal to 25 crore, right? The account can be upgraded only if it performs satisfactorily during the specified period. Specified period is 1 year from the first payment of interest or principal under the that restructuring package. So RBI mandates that MSME NPA must demonstrate satisfactory performance for 1 year before upgradation. So the correct answer is option B, 1 year of satisfactory performance from the first payment. Option B is correct here. For a large corporate NPA account under restructuring, when can it be upgraded to the standard? When can be upgraded to the standard? Very simple. We have to learn about the conditions of the upgradation. Um, you can think that there is a large corporate borrower, Mr. Agarwal, whose account was restructured and classified as NPA. Now, the bank needs to check whether all the facilities under his account are performing well. Only after a certain monitoring period can the account will be upgraded. See, for the all other accounts which are non-MSME, which are the non-MSME, upgradation occurs only if all loans, facilities perform satisfactorily during the monitoring period. Monitoring period is from restructuring implementation till at least 10% of principal and capitalized interest is paid. Minimum 1 year from the first payment is mandatory before upgradation. So, for a large corporate NPA account under restructuring, when can be upgraded to standard? RBI specifies that thing. All the facilities must show satisfactory performance and at least 10% of principal plus capitalized interest must be repaid. Minimum 1 year monitoring is mandatory. So the correct answer is option B here, that after satisfactory performance during the monitoring period and 10% of repayment. So option B is correct here. What is the provision requirement for a loss asset which is retained in the books? Here we can learn with the help of example. Let's take the example of your branch in Hyderabad. Now, three borrowers are there: Mr. Singh, substandard; Mr. Mehta, doubtful; Mr. Das, loss. These have been classified as NPA. You notice the bank is losing interest income and also need to make provisions to cover the potential losses. How should the bank account for this? NPA affects the bank profitability. Interest income loss means bank stops earning the interest, right? Provision requirement, bank have to obviously keep our money aside for that depends on the NPA category and security value. So loss assets should be written off if retained. 100% provision of outstanding required. Doubtful assets are basically for the unsecured portion, 100% amount is needed to be set aside, and for uh, secured portion, provision based on duration in doubtful category. So if the thing is, if the doubtfulness is up to 1 year, in that case, 25% provision is required. If there is 1 to 3 years, then 40% provision is required. But more than 3 years, 100% provision is required. So, normal substandard assets in normal condition, so 25% provision is okay. Infrastructure loans with the safeguards, they need 20% of provision. But the thing is there, safeguard means infrastructure loans with the escrow account. What is the meaning of escrow account? Escrow accounts are those accounts basically which are secure third party managed account that holds fund or assets on the behalf of two transacting parties, right? Escrow account is a account where funds are held in trust with two or more parties to complete a transaction, right? So what is the provision of requirement for a loss retained in books? That is 100% of outstanding. 100% means loss assets must be written off. It kept on books. Full 100% outstanding must be provided in that case. Got it? Now, for a doubtful asset which has remained doubtful for 2 years, what is the provision requirement for the secured portion? For a doubtful asset which has remained doubtful for 2 years, what is the provision requirement for the secured portion? So, RBI mandates here 40% of provision for the secured portion of doubtful asset which are there for 1 to 3 years in doubtful category. So the answer is option B, that is 40%, right? So basically NPA can become standard after clearing all the arrears and monitoring period. In the MSME account, upgradation after 1 year of satisfactory performance is possible. In the case of large account, they have to meet repayment and performance criteria. In the case of provisioning norms, loss required 100% provisions. Doubtful require 25 to 100% provision, and substandard require 20 to 25% of provision. So now with this, let's move to the next question. What is the general provision required for farm credit and SME standard assets? Farm credit and SME standard assets. Again, imagine one more thing. Suppose you are a managing branch in Pune. Your bank has given various types of loans to the farmers, to the small businesses, builders, housing borrowers. Most of these borrowers are paying regularly. So their accounts are considered standard. But even for standard accounts, RBI require banks to keep set aside a small provisions to prepare for any type of unforeseen losses. Standard assets are those loans that are performing normally, like in which interest and principals are being paid on time. So bank must make general provisions for the standard assets as a percentage for the funded outstanding. So for this, we have uh, basically for the farm credit and SMEs, provision must be 0.25%, right? For commercial real estate, commercial real estate provision must be 1%. And for the housing loan, that provision must be 2%. And for any advances, that must be according to the norms of prudential norms, right? So restructured advances. So what is the general provision required for the farm credit? RBI mandates that 0.25%. See, these things you have to be learn because questions can be there in numerical portion. So option B is correct, right? 0.25%. You have to be learn these particular percentages. Now, what is PCR? Provisioning coverage ratio. Very simple provisioning coverage ratio is concept is very easy. You can say your branch has 100 crore in NPA. Out of this, bank has kept rupees 60 crore aside as provision. How do we know whether the bank is sufficiently prepared for potential loan losses? Provisioning coverage ratio is generally provisions divided by gross NPA. Provisions divided by gross NPA. Right? It basically indicates what? It indicates the extent to which the bank has kept set aside to cover the losses. Right? So, higher PCR means the bank is prepared to absorb the NPA losses. PCR shows how much provision the bank has kept aside relative to its NPAs to absorb potential losses. So the correct answer is option B, funds set aside to cover the loan losses. What is the main purpose of CRILC? CRILC. CRILC is Central Repository, Central Repository of Information on the large credits. So what is this? Suppose your branch lends to a large corporates for 150 crore. RBI want that all the lenders to share and check information on such large loans to monitor default and avoid excessive exposure. This is where the CRILIC concepts comes in. Means CRILIC purpose is to collect, store, disseminate the credit data of the large borrowers to all the lenders. It helps bank to monitor NPAs, avoid overexposure, and take early corrective action. So what is the main purpose of this? Its main purpose to monitor the large exposure, take the early actions on the potential NPAs to collect, store, and share the data on the large credit. Option B is correct. So, who can initiate the corporate insolvency resolution process under the IBC? Who can initiate? IBC is Insolvency and Bankruptcy Code 2016. This is the consolidated framework for the insolvencies of the companies, LLPs, partnerships, individuals. And here, basically, insolvency resolution happens in 180 days. Insolvency professionals have to manage the process. Bankrupt individuals face here restrictions, and strong legal framework is here to cover the NPAs. So who can initiate this? Financial creditors, operational creditors, corporate debtors, because IBC allows banks, creditors, company itself to initiate CIRP for faster resolution of the NPA. So option B is correct here. Now, what is the primary objective of the bad bank? Primary objective of the bad bank. Bad bank means that is the financial entity who buy the NPAs from the commercial banks. That buys the NPAs from the commercial banks. They basically ease the burden of stressed assets. They free the banks to lend again. And bad banks always focus on removing the stressed assets from the commercial banks to restore lending capacity, and profit is secondary here. So the correct answer is buying the NPA from the banks to ease their burden. So option B is correct here. So bad banks focus on removing the stressed assets from commercial banks, standard assets where bank have to keep general provision even for performing assets. Provision coverage ratio is measuring the preparedness for the banks to absorb NPA losses. CIRLC is RBI platform to share and monitor large exposures. IBC 2016 is a legal framework for time-bound recovery of the NPA, and bad bank, which entity buying the NPA to ease the bank burden and restore the lending. Now, what percentage of the agreed price will NARCL pay in cash when acquiring bad loans? What percentage? So we have to keep this thing in mind that what is the meaning of NARCL? NARCL is simple, National Asset, National Asset Restructuring Company Limited. Right. That means this is the official bad bank in the India. Uh, its purpose is to buy the assets, stress assets from the commercial bank. So commercial bank can clean up their balance sheets, and basically they already acquired 2 lakh crore assets, 2 lakh crore in the phases. They pay the banks 15% cash immediately, and leftover 85% they paid in the security receipts. So basically they pays 15% of cash. Now, what is the provision required for a doubtful asset which has been in the category for 2 years secured position? See, this is a complete table, and I already told you that for the doubtful assets which are there in the category of 1 to 3 years, that means doubtful second, they requires 40% provision as per the RBI guidelines. But you have to learn the complete table because doubtful categories are also divided into three parts: doubtful one, doubtful two, doubtful three. Then loss assets are there after the doubtful, substandard secured, substandard unsecured, substandard infrastructural loan unsecured. So these categories are there that must be keep in your mind. Okay. Now the next question is here. Why do banks need to accelerate provisioning for unhedged foreign currency exposure? See, um, basically, highly unhedged foreign currency exposure can increase the probability of default. So, unhedged foreign currency exposures can increase the likelihood of borrower default. So bank have to keep the provisions extra. So the correct answer is here option B, because currency volatility increases the default risk. So option B is correct here. Now banks are required to make available on their website what? What they have to require on their bank have to disclose full terms and conditions of all the instruments which are included in the regulatory capital. They have to keep their information updated in the prescribed form on the website. It ensures that banks are transparent and confidence, just to gain the confidence of the investors. So RBI mandate this thing. Complete disclosure of all the capital requirements for transparency and for the compliance. So answer B is correct. Full terms and conditions of all the instruments in the regulatory capital. Okay. Now your branch in Mumbai and has the following borrowers and loans. Mr. Sharma, who is a borrower in the infrastructure sector with substandard unsecured loan of 10 crore, overdue for 8 months. Mr. Verma, MSME borrower, doubtful loan of 5 crore, doubtful category for 2 years, but secured with the collateral covering 60% of the loan. XYZ, a corporate borrower with loss asset of 50 crore. ABC Bank has a large NPA exposure and planning to sell stressed loan to the NARCL. Recently, the government has introduced NARCL, which will buy bad loans, paying 50% in cash and 85% in security receipt with a government guarantee of 30,600 crore in the case of losses. Now, that what is the provision requirement for Mr. Sharma substandard unsecured infrastructure loan? The simple answer is there. Substandard unsecured infrastructure loan attract a provision of 20% as per the RBI norms. And for the Vermas, how much provisions? If doubtful loan is for the 2 years, in that case, 40% provision must be maintained. And for what is the provision requirement for XYZ loss asset? 100% because this become now loss asset. 100%. And if your bank wants to sell stress assets worth 500 crore to NARCL, how much cash will the bank will receive? 15%. 15% of 500 crore is 75 crore. So this 75 crore will be there in the cash. Why would the government guarantee under the NARCL will be invoked? Government guarantee covers difference between commercial bank expect and what NARCL raises if loan is sold at loss. So if the bad bank sell the loan at a loss, that that is the government guarantee invoked. So option B is correct. Mr. Kapoor, SME account for unhedged foreign currency exposure. Why should the bank make accelerated provisioning? See, high unhedged foreign currency exposures increases the risk of borrower default during the exchange rate volatility, which require incremental provision as per the RBI circular. So, currency volatility increases default probability. Right? Now, here we have to see this PCR question. Bank acts as gross NPA, right, of 2,000 crore. Now, here, bank has the provision of 1,200 crore. So, how the PCR can be calculated? As I told you, PCR is provision divided by gross NPA multiplied by 100 to find the percentage. So, that will be equals to here 60%. That is the PCR. Got it? So in today's class, we are going to start liquidity management, a very good important chapter where we will learn the concepts with the help of story and some explanation and MCQs. So let's start with the class. Try to give the answers with the help of MCQs that will help to brush up our concept. So let me tell you about the liquidity concept first. See, imagine there is a bank called Safe Trust Bank. Every day customers came to deposit the money, withdraw the money, take the loans, repaying the loans, to transfer the funds. Right? One day suddenly, many customers come to withdraw their deposits at the same time because of some market rumors. At the same time, some borrower delay repayment of loans. Right? Now the bank must pay depositors immediately. But most of its money is locked in long-term loans and the investment. If the bank does not have enough cash, okay, so what I am saying about the bank where all the depositors come together to withdraw their money, right? Now, liquidity management is what? Keeping enough water in a tank. So if many taps are opened at once, water does not run out. A good bank always plans in advance so it can meet all payment obligations on time without loss and without panic. Right? That is called the liquidity risk management. Liquidity risk management means the process by which a bank ensures that it can generate sufficient funds at the reasonable cost to meet all of its obligation at the time. That is the liquidity management. And why it is important? Because it builds the confidence. If the bank is financially sound but suddenly faces heavy withdrawals of wholesale deposits due to market rumors, at the same time, some sanctioned but undrawn credit limits are being fully utilized by the customers, the most appropriate classification of the liquidity risk involved is C. How many types of liquidity risk are there? We have external liquidity risk, then we have internal liquidity risk. External liquidity risk arises due to the factors outside the bank. It may be geographic, systemic, instrument specific. Internal liquidity risk, this arises due to perception about a particular bank. If people lose confidence in a bank, they may withdraw funds even if the overall system is stable. Right? So, other categories of liquidity risk are funding risk, time risk, call risk. Funding risk is that risk when expected inflows do not come on time. That is the time risk. Funding risk is different if it arises when the bank needs to replace some unexpected outflows, such as premature withdrawal of deposit and non-renewable of deposit. And call risk, it arises when contingent liabilities become actual liabilities. So here, heavy withdrawal of wholesale deposits creates what? That creates unexpected cash flows, right? When the unexpected cash flows is there, cash outflows is there, this is funding risk because the bank must replace these net outflows due to non-renewable or withdrawal of deposits. So, utilization of sanctioned credit limit means non-fund based or committed limits are converting into the fund-based exposure. This is called call risk because contingent liabilities are crystallizing here, right? So we can say the correct answer of this option is funding risk and the call risk. Option B is correct here. Funding risk and call risk. Now, if a bank has following data, short-term liabilities are of 500 crore, liquid assets are of 250 crore, volatile liabilities are 300 crore, total assets are 1000 crore. So which statement is appropriate here? Which statement is appropriate here? So here simple. Suppose if the manager of the bank wants to know the bank's liquidity position today, he takes the snapshot of that balance sheet. He looks at how much liquid assets are available and how much deposits are there, how much short-term liabilities exist, and how much loans are there. Right? This is like checking that how much cash is there in your wallet right now without thinking about future income or expenses. It tells about the present position. So, stock approach measures liquidity based on the level of assets, liabilities, and off-balance sheet exposures on a particular date. It focuses on the balance sheet ratios to assess that whether the bank has currently having the sufficient liquidity assets relative to their liabilities, right? Some important ratios are there like core deposit to total assets, net loans to the total deposit, time deposit to the total deposit, liquid assets to the total assets. So if a bank has the following data, we can say short-term liabilities are there of 500 crore, right? And liquid assets are of 250 crore. So the ratio of short-term liabilities to liquid ratio is generally here 2, is 2 here. So that means if all short-term liabilities demands the payment, liquid assets can cover only half. Even though liquid assets are 25% of total assets, this does not guarantee safety because the structure of liability matters. So liabilities are here 300 crore, which means 30% of the total assets. This does not guarantee safety because the structure of liability matters. This is not negligible and it also indicates the risk. So stock ratios clearly indicate high short-term liquidity pressure. So option B is correct here. The bank faces high short-term liquidity pressure because short-term liabilities are twice the liquid assets. So option B is correct here. Now, if a bank prepares a maturity ladder and finds a negative gap in the 1 to 3 month bucket under stress scenario, but positive gaps in the longer buckets, what is the most appropriate interpretation here? Most appropriate interpretation. So, let me tell you, very simple. You can think that if the manager of the bank does something different, instead of just looking at today's balance sheet, he prepares a schedule for the next 1 month, 3 months, 6 months, a year. He write down where, when loans will be repaid, when deposits will mature. He also estimates how many depositors may withdraw early. He prepares different scenarios such as normal condition, stress condition, crisis condition. This is like a preparing monthly budget at home. Like you list your salary inflow and your expenses month by month. And if you see the deficit, obviously you plan in advance, right? So flow approach means that measures the liquidity by calculating the net funding requirement based on the residual maturity of the assets and the liabilities. It has three major dimensions: measuring and managing net funding requirement, managing the market access, and also the contingency planning. So if there is a negative gap in the 1 to 3 month bucket under the stress scenario, that means expected outflows here, expected outflows exceed the expected inflows, right? During that period, even if later buckets show surplus, the bank may fail to meet the immediate obligation. So liquidity risk is the mainly about survival in the short term. Bank fail due to inability to meet their payments, immediate payments not due to long-term profitability. Therefore, we can say the bank have to arrange short-term funding, improve liquid assets, or activate contingency funding plan. Contingency funding plan is generally a emergency plan, right? Contingency funding plan is the emergency plan is just prepared to meet any type of uncertain future event. And this shows why flow approach is dynamic. and more realistic than the stock approach. It captures timing mismatch, which is the core of the liquidity risk. Right? So we can say the correct answer is option B. The bank faces short-term liquidity stress and must arrange the funds immediately. So option B is correct here. Clear? Clear that thing? I hope thing is clear. Now, next question. Safe Trust Bank is evaluating the liquidity under the stress. It finds cash inflows from maturity loans, expected withdrawals of core deposit, wholesale deposit with early withdrawal options, backup lines of credit available. Under a bank specific crisis scenario, what is the net funding requirement for the next period? So, what is the answer here? Let me tell you about the answer. Okay. So, here first we have to learn what we have to learn that this Safe Trust Bank wants to know how safe it is in the different scenarios. If the market conditions are normal, everything is fine. Market are stable, customer trusts the bank, withdraw happens, whatever expected, bank looks very liquid. For the bank specific crisis, if something bad happens, maybe fraud occurs or rumor spread, people rush to withdraw the money. The bank is marginally liquid. It has enough cash, but under stress. In the general market crisis, the entire banking sector or market is trouble, right? Even if the bank is strong, other bank fails and market freeze. So bank may appear quite liquid because investors trust it more than others. Or market rules allow some type of support. So if the bank evaluate liquidity under multiple scenarios to understand its risk exposure, these scenarios are general market condition, bank specific crisis, and general market crisis, right? So here we can say how to find the net funding requirement. Net funding requirement is equals to outflows, outflows minus inflows plus any type of contingencies. That means how much outflow is there? That is, outflow can be calculated as that core deposit withdrawals plus wholesale deposit, which is likely to run off, minus backup credit line. So near about 70 crore, right? Then subtract 200 crore, which is the cash inflows. That will give you how much? 130 crore, right? Negative 130 crore, which means negative number indicates inflows exceed the immediate outflows. So bank has surplus liquidity of 130 crore. So that's why here we can say option D is correct, 130 crore. Clear? Liabilities are always classified into the three categories: contractual cash flow reducing outflows, core deposit that remains in the mild stress and run off slowly, and all the remaining liabilities, which includes wholesale deposits, non-contractual maturities, which are prone to the sudden outflows. Now, next question. Next question is saying, safe bank trust is highly liquid under normal condition, but faces stress in the interbank market. So, which of the following strategies is more effective to manage the market access risk? See, managing the market access involves ensuring that the bank can obtain funding from various sources under normal and stressed conditions. Here are the key points. Borrow from the multiple sources such as interbank market, corporate deposits, wholesale markets, and central bank facilities. Monitor cost of funds. The cost should be reasonable. High borrowing cost should be there. That can hurt the profitability. And some sources may be more stable, other less predictable, and wholesale borrowing is there. And also maintain the relationships because that will obviously improves during the crisis time. So relying on the only overnight interbank borrowing is risky because market freeze may prevent the access, right? And selling the long-term assets under stress that may incur losses that is not sustainable, and ignoring the wholesale borrowing that limits the flexibility. So best practice is one and only diversification. Diversify the borrowing sources and maintain backup credit lines. Diversification using multiple funding sources and backup multi facilities which ensures liquidity even if some channels are dry. So, which option is correct here? Option B is correct here. Now, next question. In the next question, they're asking about the Safe Trust Bank. Again, Safe Trust Bank is has emergency lines of credit, high quality securities, core deposits are there. During the sudden market widely liquidity crisis, which component of contingency planning is more critical in the first hour? So, very simple. We have to learn about the contingency planning. That bank can respond effectively. Bank can respond effectively when when there are unexpected liquidity shortages are there, right? So contingency planning ensures that identify the potential stress events, that determine the emergency sources, that develop the action plans, that test the plan, that assigns the responsibility. So that contingency planning complements stock and flow approaches by preparing for extreme but possible events. So that Safe Trust Bank, in the first hour of liquidity crisis, the bank priority is immediate cash inflow to meet the obligation. Long-term growth or new loans are irrelevant during the emergency. Waiting for the market to return is risky and could lead to failure. And liquidating the high quality marketable security and using the pre-arranged emergency credit lines that ensures obligations are met and that avoid panic selling of less liquid assets. So what is the correct answer? Activating the emergency borrowing and liquidating the high quality securities. Option B is correct here. Now, if Safe Trust Bank has 200 crore in letter of credit and 150 crore in financial guarantees outstanding, no defaults have occurred yet. So, which statement is correct regarding the liquidity risk? Which of the option is correct here? Very simple. What we have to see here that if there are in the first hour of liquidity crisis, the bank immediate priority is cash inflows to meet the obligations. Long-term growth or new loans are irrelevant during the emergency. Waiting for the market return is risky and could lead to the failure, right? And also that in the basically here we can say that which statement is correct according to this. Off balance sheet items, they are not reflected as current cash flows, cash outflows. They can become actual liabilities, but under some conditions. If the client defaults, the bank have to honor the letter of credit or guarantee immediately, which could restrain the liquidity. So proper risk management involves what? Identifying, measuring, planning for contingent cash flows. So liquidity risk exists because there are contingent liabilities that could require immediate payment. So option B is correct here. Now, if Safe Trust Bank handles clearing services for 10 smaller banks on a certain day, outflows are 50 crore more than inflows due to unexpected settlement volumes, what its implications are there. Simple, simple answer is there. Bank have business operation that generate unpredictable cash flows, right? Now, these operations are required to maintain the excess liquidity to meet any unforeseen fluctuations. Even predictable operations like clearing can create short-term liquidity gaps, right? Banks have to plan for excess liquidity to absorb such type of fluctuations. Ignoring these flows can lead to fund depletion during unexpected stress. So, Liquidity risk arises even though bank operations are stable. So option A is correct here. Again, Safe Bank Trust relies 70% on single wholesale funding source in one city. So which of the following is the best practice here? See, bank have to evaluate that what are the individual funding sources, right? What are the individual funding sources? By the type of the instrument, by the provider type, by the geographical market. That diversification is that thing which ensure that bank can access the funds even if that one source fails. So here, Safe Trust Bank is relied on 70% on the single wholesale funding sources. So heavy reliance on single source can increase the concentration risk, right? That increases the concentration risk. And diversification across multiple sources reduces sudden liquidity shortfalls, right? So cheap funding is attractive but can be dangerous if the source disappears during the stress. So the correct answer is diversifying the funding across instruments, providers, and the regions. Option B is correct here. Next question. Next question is saying during a sudden liquidity crisis, Safe Trust Bank plans to use pre-arranged credit lines from the central bank. So which part of contingency funding does this illustrate? What is contingency planning? Contingency planning is basically ensures timely access to the funds for smooth operation. It is like an emergency plan which is prepared for any uncertain situation. Now, there is a sudden liquidity crisis. So, credit lines and unused facilities that represent emergency liquidity sources. They are pre-arranged and that can be activated immediately. That ensures to meet the obligations but without without selling any assets, right? So strategy for handling a crisis is broader and it includes coordination, responsibilities, and also the communication. So contingency is like a backup liquidity for emergency situations. So that's why option B is correct here. Now, Self-Trust Bank is assessing its liquidity under stress scenario. Full deposits are 500 crore. Wholesale deposits are 300 crore. Letter of credit outstanding is 150 crore. Financial guarantees are 100 crore. Liquid assets are 400 crore. Unused central bank credit lines are 200 crore. Clearing obligation to correspondent banks daily fluctuations about 50 crore. Now, during a bank specific crisis, which of the following is the most accurate assessment of the bank net liquidity requirement? See, here we know that in the liquidity risk management, it is very important about the different ratios. If I talk about the core deposits, that core deposit means core deposits are the stable and they will largely remain with the bank, right? Wholesale deposits are volatile and likely to run off immediately when the stress situation is there. Off balance sheets, letter of credit, and financial guarantees. These are the contingent liabilities. And clearing obligations, meaning daily fluctuations that will add unpredictable, significant cash demands. So, how much wholesale is there? 30, sorry, 300 crore and 150 crore is letter of outstanding. So, we have to add these 300 plus 150 plus these guarantees and clearing, which will give us how much crore? 600 crore. And if we add here the available liquidity, 400 crore is of liquid assets, 200 crore is unused bank credit line, which is equals to 600 crore, right? So net liquidity position is tight here, leaving no margin for unexpected stress or delays. So that means core deposit alone cannot prevent the stress. The bank management must have a coordinated crisis plan and also pre-arranged access to the emergency liquidity. So here option B is correct. The bank will face significant net liquidity requirement due to immediate runoff of wholesale deposits, contingent liabilities, and clearing fluctuations, even though core deposits and liquid assets are exist. So option B is correct here. Now, if a bank is exposed to various liquidity risks, sudden premature withdrawal, unexpected delay in loan repayment, conversion of non-fund based limits, market-wide freeze that affecting all the bank. So which of the following matches the current liquidity risk category? See, what is funding risk? Which is arises from the anticipated cash outflows, right? Such as early withdrawal of deposits. What is this time risk? Time risk is occurs when expected inflows are delayed. What is call risk? That is triggered by the uh, crystallization of contingent liabilities and the conversion of the non-fund facilities into the fund based. And what is external risk? These are market wide, some external factors are there which affect the bank's liquidity. So here, if we say core deposits, uh, like funding risk are the unexpected withdrawal, time risk is the delayed payment, call risk is the conversion of non-fund based limits, and external risk is market wide freeze. So the correct answer is here option A. That matches the correct liquidity risk category. Now see the last question for today. Safe trust bank data is given. So which of the ratio indicate the liquidity positions of the bank? So for this we have the simple answer, that is the core deposit, because deposit is divided by total assets, which will give you 400 divided by 1000 crore. So that means it is equals to 0.4. And net loans will be divided by total liabilities. 700 crore by 150, which will give us the 0.7. And that short-term liabilities divided by liquid assets, 150 crore divided by 250, that means near about 0.6, because lower value indicates better liquidity coverage for immediate obligations. So that means the correct answer is here option number A. A option is correct here. So we have to find what happens to NII in the short term. See, a very simple answer. Here we know that. Imagine a bank manager, he gives 5-year fixed rate home loans that are assets, but only accepts 1-year fixed deposits. After 1 year, deposit rate increase sharply due to policy tightening. Now he must pay higher interest on the deposits, but home loan interest remains fixed for 5 years. So in that case, his profit start shrinking, right? Why? Because assets and liabilities were not aligned in the repricing timing. That is called gap risk. Gap or mismatch risk arises when assets and liabilities have different principal amounts, maturity dates, and repricing dates. So, gap is equals to rate sensitive assets minus rate sensitive liabilities, right? That is only on a given time bucket. So, what is positive gap? Positive gap means when the return sensitive assets are more than return sensitive liabilities. What is negative gap? Negative gap is when rate sensitive liabilities are greater than rate sensitive assets. So here in the given question, if interest rate rise, positive gap means NII increase. If interest rate rise, that is the negative gap, NII will decrease. So if a bank has 0 to 1 year bucket, how to find the answer here? Very simple. First find the gap, that is 800 minus 1200 crore, which is minus 400 crore. So this is the negative gap. Negative gap. So when interest rate rise, liability cost rises on 1200 crore and asset yield rises only on 800 crore. So more liabilities here reprice upward than the assets. Cost increases more than the income, and that will gives the declines in the NII. NII is decreases. So option B is correct here. Now, if a bank fund itself at repo linked rates and lends at treasury bill linked rates, during the tightening, repo increases by 1.5%. T-bill increases by 0.8%. So what is the impact? What is the impact here? See, simple explanation of this question is about the basis risk. Basis risk arises when different benchmark rate change by different magnitudes, right? Example, if assets are linked to the MCLR, liability is linked to the repo, or SOFR versus treasury yield. means if the repricing dates match, mismatch in the reference rate movement creates volatility in the NII. So a bank funds itself at repo linked rates and lends at treasury bill rates means funding cost here rises by 1.5%, right? That is the funding cost that rises by 1.5%. And asset yield rises by only 0.8%, right? So if spread compresses, if the spread compresses, that means NII here contracts. That means there is the adverse basis movements, which means repricing tag, but still NII is affected. That is the basis risk, not the gap risk. So we can say the answer is adverse basis shift. Option B is correct here. Clear? Now, next question. In a falling rate environment, which causes maximum damage? Which causes maximum damage? See, in a falling rate environment means bank always loses high yield assets and they reinvest at the lower rate. Asset yield declines here sharply. That means spread here is compresses. So that is the convexity risk extension in the IRRBP. So we can say that prepayment of high rate loans causes the maximum damage. Prepayment of high rate loans. So option B is correct here. Suppose if a bank borrows short term and lends for long term. If yield curve flattens because short term rates rise, long term rates unchanged, what is the impact of it? See, yield curve risk arises. Why? Because of changes in the slope. Because of changes in the slope. If a bank borrows short term and lends the long term, that means yield curve flattens. So, which means in that case, cost is increased and income is unchanged, which basically gives net interest margin will obviously shrink. So it spread the narrows in that case. It spread the narrows in that case. Which instrument has highest reinvestment risk? Which instrument has highest reinvestment risk? Reinvestment risk is the uncertainty about the cash flow, uncertainty about the cash flow, that future cash flow will be reinvested. So simple, uh, this is high in the coupon bonds and amortizing loans. So in that case, which instrument has the highest reinvestment risk? That is high coupon bond. Why high coupon bond? Because whatever the higher coupons are, in that cases, we have more interim cash flows, which means more reinvestment exposure is there. And if there is zero risk, there is no interim cash flows, no investment risk. So zero coupon means price risk is high here and reinvestment risk is zero. So that is high coupon bond. Option B is correct. If a bank shows 0 to 6 months gap, 6 to 12 months gap, if interest rate rises sharply in short term, but expected to fall after 6 months. So what is the overall impact in that case? See, this repricing schedule distributes the interest sensitive assets, then interest sensitive liabilities, and OBS off balance sheet positions. And we know that gap is equals to rate sensitive assets minus rate sensitive liabilities, right? So it is used primarily for earnings, the perspective, and short-term NII sensitivity. It ignores the time value of money. It also assumes the parallel shift and it ignores embedded options. So negative gap means rate rise here, and if rate is raised, NII also rise. But if rate falls, sorry. So NII also falls. If this is happens in the negative gap situation, right? So we can say there is a difference, there is a relationship, inverse relationship in the negative gap. Because if rate rise, NII fall, right? NII fall. But in the positive gap, if rate fall, NII falls again. So we can say gap analysis captures the time bucket sensitivity, not full life cycle impact. So option C is correct here. Short terms NII falls, later partially recovers. Option C is correct. Now, bank economic value of equity duration gap is given, interest rate shock is given, approximate changes in EVE is. What is the meaning of duration? Duration means that sensitivity of economic value, sensitivity of the economic value to the interest rate change. right? That means percentage change in price is modified duration multiply percentage change in the uh, price, you can say, percentage or yield, you can say, multiply by yield. So it is used for the economic value perspective, for the long term structural risk, and for the IRRBB capital impact. So here we can say minus 3.5 multiplied by 0.02, which is equals to 0.7 minus 0.07, which is equals to 7%. So duration gap captures the capital sensitivity, not the NII sensitivity, right? So option B is correct here. Which method best captures behavioral deposit changes and embedded options? See, if I give you some overview here, just a second. First, let's understand some concept which is important about the interest rate risk management. See, what is the meaning of that interest rate risk? Interest rate risk is basically happens due to the fluctuations in the interest rate. We know that thing. Now, this risk is one of the dangerous risks because it causes a lots of situations for the banks, which is important to manage, right? So, lots of strategies are there, lots of things are there to manage this interest rate risk. Now, the most important thing in in this chapter, we have to learn about that what are the causes of that interest rate risk and why this interest rate risk is important to manage. And in a bank liquidity management, this is the process of generating the funds, generating the funds to just meet its contractual relationships at the agreed prices. Effective liquidity always happens when a bank serves that marketplace, the bank is safe and therefore it is capable of repaying its borrowings. Also, when it lowers the size of the default risk premium, the bank, whatever, must have to pay for the funds. So, how many types of liquidity risk are there? External liquidity risk and internal liquidity risk. In the external liquidity risk, they can be geographic, system, or instrument specific. Whereas internal liquidity risk, they relates to the large perception of institutions. And how to measure and manage the liquidity risk? First, develop a structured uh, for managing the liquidity risk. Then set the tolerance level and at last manage it. Right? So there are things which are important for the interest rate risk management. First is you can also assume contingency planning because contingency planning is like a emergency plan. Emergency plan for any uncertain events. And these plans spell out at clearly as possible the amounts of funds available for the banks from these sources so banks can use them. So that is the only thing you have to learn in the interest rate risk management. Just the definition, measures, and the types. That's enough. So in today's class, we are going to learn about RAROC, a very good chapter, where we will learn how banks do planning of the profit and the things related to the RAROC, risk adjusted return on capital, which is basically used to measures the investments, and while it is accounting for the risk, means ROI helps compare investment of varying risk levels by just adjusting the returns with the expected losses. That is the meaning of the RAROC. A very important thing for a bank. It is a modified return on investment figure that takes the element of risk into the account. That is the concept of RAROC. Now, this is completely different from the measures which are incorporating the risk factors. And RAROC is a useful tool in assessing potential acquisitions. It assumes riskier in the investments, right? It assumes riskier investments that offer higher return. And yes, companies need to compare two or more different projects or investment they have to keep in mind. That is the concept of RAROC. So here, first we will learn about profit planning in the banks, which is the most important thing. Profit planning in a bank means planning how to earn maximum profit while controlling the risk. With the risk management, how to earn maximum profit. A bank earn income from three main sources. First is interest income, which comes from the loans that is given to the customers. Second is fee-based income, which is like processing fees, ATM charges, locker rent, internet banking. Third is treasury income, which comes from trading in the government securities, foreign exchange, derivatives, and other financial instruments. That is called profit planning in the banks with the three main sources of the bank income: interest income, fees-based income, treasury income. And in the 1990s, that bearing bank collapsed because of excessive speculative trading losses. So it is important to do the trading but within the limits. And on the expense side, banks have interest expenses, staff expenses, and other operating expenses. Right? So profit will increase. Profit will increase, no problem in that. Profit will increase when income increases and expenses decrease. And a bank has to balance lending and investment according to its risk appetite. Profit increases when the income increase and the expenses decrease. Right? So first question is there. A bank increases its treasury trading exposure to boost the short-term profit. At the same time, it reduces staff and operating cost. However, the volatility of earnings increases significantly. So which of the best describes the impact on profit uh, planning? So which answer is correct according to you? See, I told you even though expenses are reduced and income may increase. So, volatility means higher risk. Profit planning is not only about increasing profit, it is about increasing the profit at an acceptable level of risk. If the risk increases too much, that means overstability decrease in that case. So profit planning may actually worsen in that case. So profit planning has deteriorated because risk adjusted profitability may decline. Got it? Now, next question. Uh, Next question is about the risk aggregation. Risk aggregation means combination of the all types of risk in a bank that measures total risk. And one common method is risk adjusted return on capital, which is called RAROC. It measures that how much return a bank earns compared to the capital which kept to absorb unexpected losses. There are two types of losses. Expected loss, which is basically generally expected that this type of situation may occur in the future. So bank prepare all the plans according to that type of losses. Unexpected loss is rare but very severe loss because it is not planned. It is a type of a sudden situation. So that type of loss is not prepared by the banks or no planning is done by the banks. That happens once in a year or once in a many years. So these types of losses are covered by the economic capital. So that RAROC helps comparing different business units fairly by adjusting profit for risk. That is called risk aggregation and RAROC. So, two division of a bank generate equal profit. Division X require significantly higher economic capital due to higher credit risk concentration. Division Y has diversified exposures and require lower capital. So, which division has better performance according to the RAROC framework? So, very simple. RAROC compares profit with the economic capital. If profit is same, but one division uses less capital, it generates more return per unit of capital. That division has better risk adjusted performance. So the answer division Y because return per unit of capital is higher. So option B is correct here. Now, what is the meaning of economic capital? Economic capital is that capital which is maintained to just absorb any unexpected loss. And all those unexpected loss are covered by the provisions which our bank have to set aside for the unexpected loss. So, we can say unexpected loss are only covered by the economic capital. If the activity is very risky, it require more economic capital. And more capital means bank expect obviously higher return from that particular activity. Economic capital helps the bank in deciding pricing and performance evaluation. That is called the economic capital, which is generally used for the unexpected for to cover the unexpected losses. So if a high risk corporate lending portfolio requires substantial economic capital allocation, if the bank prices loan without considering economic capital cost, what is the most likely consequence? So the simple answer is there. If the capital, economic capital is ignored, right? If the economic capital is ignored, the bank do not charge enough for the risk. That means if the returns look high, it does not compensate for the risk. And with that time, shareholders lose their value because risk is not properly priced. So that's why underpricing of risk leading to the destruction of the shareholder value. So option C is correct here. Underpricing of risk leading to the destruction of the shareholder value. Now, what is the meaning of earnings at risk? How much a bank income may fall due to adverse movements in the interest rates. That measures that how much a bank income may fall due to the adverse movements in the interest rate. It focuses on short-term income volatility. It estimates the worst possible earnings decline at given confidence level. This is commonly used for the interest rate risk management. That tells about that if the worst moment will come, so the bank income will rise or sorry declines by that much of percent. So if a bank which is having large floating rate liabilities and fixed rate assets that faces sudden rise in the interest rate. So according to the earnings at risk framework, what is likely impact here? So very simple. What is the meaning of floating rate liabilities? Floating rate liabilities reprice quickly when the rates increase. And in that case, funding cost rises immediately. And fixed rate assets do not reprice in any cost, so income decreases in the short term. So that earning at risk captures the potential fall in the earnings. That is earnings at risk, which basically captures the potential fall in the earnings. So what is the meaning of that earnings at risk? Earning at risk is the concept that quantifies the maximum potential decline in a company's net income due to market fluctuations like interest rate, foreign exchange changes. It is used by the financial institution or the banks for the asset liability management just to ensure that stability is there in the earnings. So the correct answer of this question is, which option is correct here? Option B is correct. That tells earnings will decrease in that case due to increasing in the funding cost. So option B is correct. Now, profit planning plus RAROC plus economic capital. A bank may show you the high accounting profit, but that high profit does not mean that everything is good. Profit is not the guarantee that everything is good in the banks. Because profit always compared that what type of level risk taken, what type of economic capital used, and what is the stability of the earning. And that RAROC helps in deciding whether a business line is actually creating value or not. That business, a particular business line is creating that much enough profit for the banks or not. So how can this thing is measured? If RAROC is higher than the cost of capital, so value is created in that case. If RAROC is lower than cost of capital, then value is destroyed. So a bank has two portfolios: retail portfolio, stable income, low default rate, low economic capital requirement, and moderate profit, which is in a good one, right? Very stable income, no defaults, and very low economic capital requirement, moderate profit. But in comparison to this, if very high interest income, high volatility, high economic capital profit, and higher accounting profit. So we can say the cost of capital of the bank is 14%, and retail portfolio ROC is 18%, corporate portfolio ROC is 12%. So which decision is appropriate? Retail portfolio or corporate portfolio? According to you, which portfolio is best in that case? So very simple answer. See, here the answer of this question is corporate portfolio shows you the higher accounting profit, but its RAROC is only 12%, which is lower than the cost of capital of 14%. That means it is destroying the value. So retail portfolio has the RAROC of 18%, which is above the cost of capital. So it creates the value. RAROC based decision making focuses on the value creation, not just the accounting profit. So which option is correct here? Option, which option is correct? Option B is correct. Option B, expand retail portfolio because it creates shareholder value. Expected loss, I told you, is a normal business law. This is general, very common thing with every business. Unexpected loss is a rare extreme loss. And if pricing does not cover expected loss, operating cost, cost of capital, then bank is underpricing risk. Means here we can say if a loan bank price if a bank prices a loan only considering the cost of fund, operating cost, and target margin, it does not consider expected credit loss and economic capital charge. So what is the long term implication in that case? What is the long term implication in that case? See, very simple here. If expected loss is not included in pricing, then the future NPA will reduce the profit. And if economic capital is not included, risk is not properly compensated. Initially, profit may look high in that case, but with the time, capital will erode and stability will weaken. And that is the condition of dangerous profit planning. So we can say hidden erosion of the capital and long-term instability is the long-term implication in that case. Right? So that's why option C is correct here. Now, treasury income plus income at risk plus volatility means treasury income can be very high, but it is very full of movement, volatile. So, earning at risk measures short-term income sensitivity to income rate movement. If treasury exposures is high, income variability will increase, standard deviation of return will increase, and capital requirement will increase. So, if a bank shifts from traditional lending to the active trading in investment rate derivative, short-term profit rise sharply. However, earning volatility doubles. economic capital allocation to treasury increases significantly. So under the risk adjusted performance evaluation, which statement is the most accurate? Which statement is the most accurate? See, if profit increased, so volatility also increased, right? Higher volatility means higher economic capital. If capital increases more than profit increases, RAROC falls. If capital increases more than the profit increases, in that case, RAROC will fall. So risk adjusted performance will actually worsen. So higher profit does not guarantee you the higher value. So that's why option B is correct. RAROC may decline despite the higher profit. So option B is correct here. What is the meaning of ROA and ROE? ROA and ROE. Return on assets is the profitability ratio that measures how efficiently a company generates profit from its total assets, which is calculated by the uh, dividing net income by total assets. If higher ROA is there, that indicates the company is more effective at converting its asset investment into the earnings. That is ROA. And what is the meaning of ROE? So ROE is return on equity, which is basically a type of measuring a financial metric um, ratio which determines the company's profitability related relative to the shareholders' equity. Right. So here is the question. Here is the concept. ROA measures profit compared to the total asset. ROE measures profit compared to the equity, but neither properly adjusted for the risk differences. RAROC adjusts profit for economic capital required. That is why ROROC is superior for performance measurement in the modern banks. So if two banks show identical ROE of 16%, Bank A has concentrated exposure to the cyclical industries only, and Bank B has diversified low retail risk exposure. So which metric will differentiate their true performance? So see, ROE not shown that thing that how much profit is taken. But Bank A here may be taking excessive uh, risk to generate that 16%. And RAROC considers the economic capital based on the risk, right? So it gives you true risk adjustment performance. So one of the correct answer is there. Only the best uh, thing that differentiate their true performance is RAROC. Option C is correct here. And then risk capital. Risk capital is the amount which is basically required to absorb any unexpected losses. And suppose two traders, they are earning profit of $10 million, right? Value at risk is basically a model, statistical model, which is used by the banks to see the extreme loss situations. And if two traders both earn profit of $10 million, one is foreign exchange trader with high volatility, other is bond trader with lower volatility. Even their profit are same, performance is not same. Why? Because both of them taken the risk differently. Higher volatility means higher risk capital. And risk adjustment performance measure always profit with the risk capital. That's why that's RAPM is equals to profit divided by the risk capital. And if the profit is same but risk capital is lower, performance is better. So bond trader may be better even with the same profit. So two trading desks who are generating identical annual profit. Desk A operates in very high volatile emerging market currency segment. Desk B operate in highly rated government bonds but with stable returns. If value at risk at 99% confidence is significantly higher for desk A, what will be the likely conclusion under the RAPM framework? Which option is correct here? See, RAPM compares the profit with the risk capital, right? So, desk A need here more capital because obviously risk is high here, and desk B needs the less capital. Same profit but lower capital means better risk adjusted performance. So desk B perform better here. So desk B has superior performance due to lower capital, lower risk capital usage. So option B is correct here. Now RAROC methodology has three steps. First is risk measurement, which measures obviously exposure, volatility, correlation. Second is capital allocation, that choose the confidence level and time horizon. Third is performance measurement, which compare profit with the economic capital. So RAROC always help in deciding which business is needed to expand, how to compensate the employees, how to allocate the capital. So if a bank increases its correlation adjusted portfolio due to concentration in one sector, economic capital requirement increases sharply. However, accounting profit remains unchanged here. So, under RAROC methodology, which was most likely to happen? RAROC always compare profit with the economic capital. You can see here profit is same. That means capital is increased. So return per unit of capital decreases. So RAROC will decrease here. So option B is definitely correct here. Economic value added, which is called EVA, which measures true economic profit. Economic value added, which is helpful in measuring true profit, true value of profit. It measures company's true financial probability, which is calculated as net operating profit after taxes minus the cost of capital employed. That is basically the EVA. It is a performance metric that align the manager incentives with shareholder value creation, right? So, if a business unit earns profit of 200 crore, economic capital allocated is 1000 crore. Required return is 15%. What does this imply if EVA is negative? So, which answer is correct in that case? C. Required return on 1000 crore at 15% is that 1000 crore, 15% is near about 150 crore. So if profit after adjustment is less than required return, EVA will become negative. And negative EVA means value destruction. So option A is correct. Accounting profit is insufficient to cover the cost of capital. Then banking industries in India. After the Narasimham Committee reforms of 1991, Indian banking changed significantly. And major regulator is one of RBI. These are the types of bank in India which basically comes under the RBI regulation. And recently, associated banks are merged into the State Bank of India. RBI introduced differentiated banks like small finance bank and payment banks. So, which of the following institution cannot accept demand deposit from the public? So, which of the option is correct here? Developmental financial institutions, they are not accepting any type of deposits. So, they raise the funds from the market and the government support. Banks and payment banks can accept deposit, but DFIs cannot. So the answer is here developmental financial institution like NABFID. NABFID means we will learn this. NABFID means National Banks for Financing Infrastructure and Development. It was established under NABFID Act 2021. It is a development financial institution. It supports long-term infrastructure financing. Unlike bank, it does not accept public deposit. So why is NABFID structurally different from the commercial banks? Why this NABFID? A very important concept of this NABFID that means that full form is National Bank for Financing Infrastructure and Development. This is one of the specialized government-owned development finance institution which basically supports long-term and infrastructuring financing, and its headquarters is there in the Mumbai, and it provides financial assistance like loans, investment for the infrastructure. It acts as a facilitator for the private institutional capital. So, which of the following institution can accept here? Why is NABFID structurally different from the commercial banks? Because it is designed for the long-term infrastructure lending, right? It does not take deposits from the public. That makes it structurally different from the commercial bank. So option B is correct here. It does not accept retail deposit and focuses on long-term infrastructure funding. Now, RBI maturity buckets require bank to classify assets and liabilities into the time buckets. Basically, this thing is used to manage the liquidity risk. Buckets are tomorrow, 2 to 7 days, 8 to 14 days, 15 to 30 days, 1 to 2 months, up to 5 years. That helps in asset liability management. So mismatch between asset and liabilities in the buckets creates the liquidity risk. If a bank has large liability maturing 2 to 7 days, but assets are maturing after 1 year, what is the primary risk? One and only risk is there in these type of condition, which is simply uh, liquidity risk due to short-term mismatch. Why? Because that liabilities must be paid soon. An asset will generate cash much later. And this type of mismatch creates liquidity pressure. So it is a liquidity risk. Simple, it is called liquidity risk due to term short-term mismatch. Right. So now I am hoping that you are aware about the concepts of the RAROC. Very last chapter of this BFM module D, and very good chapter. And just go through with these topics and the questions, that what is the meaning of RAROC? Simply, RAROC is a metric that tells you about the investments, right? Then risk aggregation means segregation of all the types of risk, which tells you about the common risk, like total risk available. Economic capital is used where banks keep this capital just to absorb the unexpected losses. Earning at risk means how much a bank income may fall due to adverse movements in the interest rate. Profit planning means which shows high accounting profit. High profit does not mean good performance. Expected loss means normal business loss, and it should be built into the loan pricing. Then treasury income. Treasury income is basically very high. It can be volatile, and if the treasury exposure is high, so income variability will increase. ROA is a ratio that measures the profit with the total asset. ROE is measuring the profit compared to the equity. Then RAROC methodology has 3 steps: risk measurement, do the allocation of the capital, and do the performance measurement.